Thank you all for joining. My name is TJ Burns, founder and principal of Burns Capital Partners. And today we're discussing the Burns Income Fund 2, named 2 because this is the second debt offering that we're bringing to our investors. And we'll talk more about our partners on this fund, Bozeman Capital Partners and Kunal, who joins us from their team. First, a disclaimer, this is not a solicitation. Please read through this at your own time. And first, I'll go over an overview of the offering. So like I said, we're partnering with Kunal and his partner, Charles, and their fund, the BP Mezzanine Opportunity Fund, in providing short-term debt to experienced single-family house flippers. So the underlying asset is single-family homes. And what we're doing is we are retaining a small portion of those loans in mezzanine debt. If you don't know what mezzanine debt is yet, we'll discuss it in detail in this presentation. But the thing about mezzanine debt is that you can generate much higher returns in that portion of the capital stack. It comes with some additional risks, and we'll talk about those risks in this fund and why we feel like we're mitigating those. We'll also talk about track record of the fund. They've been around for 2.5 years already. They've done extremely well. I've been a limited partner of theirs for over a year now. I've been very impressed. We'll talk about my involvement and some of the details of this offering, like the minimum investment, the projected returns, as you can see on the slide, monthly distributions, 1-year lockup period, quarterly reporting. We'll talk about the market backdrop and why we feel like it's a good time to be in the lending business. Like I said, we'll get more into the track record and how the fund's been performing, what's in the fund currently with over 300 different real estate loans. We'll talk about the delinquency rate of those loans, which has been less than 1%, which is phenomenal. Some of the risk management of the fund. And we'll start with the team and who's involved. So first, myself, like I said, my name's TJ. I started this business, Burns Capital Partners, really as a way to help myself at first. So I was working in tech and have been up until this week, actually, when I just quit my W-2 job to run this business full time. But I wanted to invest in real estate. I didn't feel like I had the avenues to do so efficiently. I found a wallet on the street just by happenstance, and that kind of got me into the business of syndications, of funds, of being a passive investor. And I did that for a little bit, had a bit of success, and then a couple of years ago decided that I saw an opportunity that I could build a business around helping the person that I used to be. And since then, I've raised a little bit over $6 million across a number of offerings. And like I said, this is our second debt offering, which has been our focus for the last year or so. So now I'll toss it over to Kunal to talk more about himself, about his partner, and about their fund.
Sure. Thanks, TJ. Yeah, guys, I'm Kunal. So before I actually got into real estate, I also have a background in tech. So I used to be a software engineer at Meta up in Seattle. And so even before that, I kind of built a financial foundation when I was working on building some algorithmic trading strategies for stocks and derivatives. So actually, at one point, I really wanted to go into the hedge fund space and become a quantitative researcher, if anybody knows what that is, but ended up doing software instead. And that kind of put me on the track of where I am today. So up in Seattle, I built a small rental portfolio and a network with a bunch of other people that were much more successful than me. And just basically by helping them out, getting involved in what they're doing, I've kind of transitioned from tech to fundraising full time and running this fund full time. So it's a little bit about me, but I think the person with the real track record and the credibility is Charles. So my business partner, Charles, is been in this industry for more than 20 years. He's a CEO and co-founder of Vontive and Certain Lending, and we'll get more into why that's relevant here. But basically, those are two mortgage companies that he runs that originate debt for business purpose loans, fixing and flipping, new construction, etc. He also actually managed a $1.4 trillion single family mortgage portfolio back in between 2009 and 2014 at Freddie Mac. So he's got a ton of experience. He's bringing the credit knowledge as well. And so, yeah, we're working together to provide this opportunity to you guys. So yeah, just a really high level overview of the strategy before we get into the details. But essentially we're kind of taking the mezzanine capital position in the capital stack. So for those of you who don't know, um, senior debt is the safest part of the stack. So as you can kind of see, like any cash flow or returns that are generated first flow to the senior debt part of the stack, and that's also the last part of the stack to absorb any losses. And so generally that is the most safe. The mezzanine debt comes slightly above or below senior debt in that uh, it realizes losses earlier than the senior debt. And it's also behind borrower equity in terms of losses. So borrower's equity is the most risky part of the capital stack. So on the left side, that kind of represents some of our loan criteria. And so actually we've been pretty conservative over the lifetime of the fund. So we actually tend to stay on the lower end of some of these risk metrics like loan to cost or loan to value, which we'll discuss on the next slide. But yeah, I think our typical loan size is somewhere averaging right now around 300K. I think our weighted average loan term is around 11 months, give or take somewhere around there. And then I think the interest rate has been fluctuating between 10% on the lower end to around 13% on the higher end. And obviously the FICO score, we try to keep that high. So we'll see some more details on the next slide, but actually, yeah, we can just go to the next slide right now. So here's some of our active loan metrics. This is actually slightly out of date by like a little bit more than a month. It's tough to keep these super up to date since we're growing so quickly. So back when we had this slide up, we had 9.8 million in the fund. As of right now, I think literally last week we just crossed 13 million, and we're still growing. So we'll get more to the senior debt and total loan amount. I think it'll make a little bit more sense later in the presentation when we talk about the actual strategy. But the main things to note here is the 6.3% mezzanine participation. So that refers to how thick that mezzanine debt slice is in the stack. So there's a certain amount of senior debt above us, and then we occupy 6.3%, and then the rest of that will be borrower equity. And so again, when I explain the strategy in more detail, I think that 6.3% number will be more relevant. So beyond that, there are a lot of risk metrics on here. So obviously, FICO score is a big one. The higher that is, the better. They're more responsible with their debt. Also, below we have the geographical diversity. So 26 different states. We're originating nationwide to basically eliminate any idiosyncratic risk from individual markets. So if we were super concentrated in one market and that happened to tank in value, then obviously that'd be bad for our portfolio. So we're trying to keep that spread out. And again, since we've grown in fund size since this slide was created, obviously we have more real estate investments. And we're above 300 now, and more zip codes as well across more different real estate investors. So finally, like the main thing, one more thing to do. Yeah. I wanted to go over loan to cost and loan to after repair value. So these are pretty important stats actually, especially when you're talking about asset-based lending. So I'm just going to assume most people aren't really super familiar with this stuff, so I'll just go through the basics. But first of all, loan to cost just basically is the loan balance divided by the total cost of the project. And basically what this represents is how much skin in the game does the borrower have up front. So maybe I'm doing a flipping project where the total cost acquisition plus renovations is going to be around 100K. If our loan that we originate is an 80K loan, that means that our loan to cost, excuse me, is 80%. And so yeah, that means that upfront out of the gate, the borrower is bringing in around 20K of their own capital. And so obviously the lower that is, that means that the more capital they're bringing in, so the more skin in the game they have and the more incentive they have to not screw up the project. Kind of similar to that is loan to value, and in this case, more specifically, loan to after repair value. So this kind of represents how much buffer you have for loss in case anything goes wrong. So the reason that loan to cost and loan to value is different here is because these are flipping loans. And so not only is the borrower putting in renovations, but those renovations ideally are increasing the value of the property above and beyond the cost of the renovations. So what this means is A, these flippers are actually buying these properties at a discount to market value. And B, once they buy these properties, they're actually adding a lot of value by renovating. And so again, the lower this number is, the better, because that means that there's more borrower equity ahead of us to absorb any losses. If in any event we need to foreclose and take the property back, we have a lot of room to liquidate even at a discount to market, and our loan principal still isn't affected. And then kind of related to that, we'll talk about the delinquency rate. It's less than 1%, but in reality, it's actually literally just one loan. And so that one was a little higher loan to cost loan that we did like back at the inception of the fund, and that's not a kind of loan that we'll do again. And yeah, every single other loan that we've done has performed fantastically. So that's kind of an overview of our active stats right now. I think we can go to the next slide.
Cool. Yeah, and I'll add too that at the bottom there, I noted the one loan that was delinquent. It was had an outstanding balance of about 68,000. At the time when we did this deck, it was expected to sell, and the fund's principal is expected to be paid back in full. So, just that was the outcome on that one.
Yeah, so I'm not going to go into every single bullet on the slide. I think a lot of this is things you'd expect. But I think one thing I'd like to call out here. So this is kind of what we expect any lender that we work with to do. And so we have that verbiage in there, but in reality, right now we're only working with one lender, which is Vontiv, which is Charles's company that I mentioned earlier. And for now, and also in the foreseeable future, we plan to only work with Vontiv. The reason for that is that since Charles is working with at both Bozeman and Vontiv, we kind of have like an insider edge where we're able to actually cherry pick the highest credit quality loans. And we also know these borrowers very well. So as of right now in the fund, Charles actually knows all of our borrowers personally or has worked with them in a deal before. So I think that's really important to note here, where that's another way we're kind of mitigating risk that's kind of intangible, that's not really numerically based, but that's super important to know. So yeah, we can go at a high level through this, but yeah, we want yeah, let's go to the borrower criteria. This is the most important part. So yeah, as I mentioned earlier, these are fix and flip loans generally for single family or 1 to 4 unit residential properties primarily. And our target is 6 to 12 month loan terms. As I mentioned earlier, I think our weighted average loan term is around 11 months. So it's kind of more skewed towards the 12-month term in our portfolio. And so one thing I wanted to mention specifically is these are all first lien mortgages. And we actually, from Vontiv's origination process, they actually don't allow the borrower to take on any second liens beyond behind our first lien positions. That also adds to the safety a little bit. And also another thing that's important to note is all of these loans are personally guaranteed. So on top of the monetary skin in the game that the borrowers put in up front with their own down payment, they also personally guarantee the loan. So technically, if we have a default, we can actually come after their personal assets as well. And then, as I mentioned, for the margin of safety earlier, this is super important. Our target is around 70%. As we saw on the previous slide, we're actually underperforming that. We're at like 65%, which is even better. Geographically speaking, I mean, these are things that pretty much everybody in the industry does. So obviously, everybody wants a market with household formation and job growth. But the important thing to note is we're definitely avoiding like tertiary markets, like more rural properties, stuff like that, because that kind of helps us guarantee our exit for the borrower. So obviously, it's much easier to liquidate a house in a market that has 200,000 transactions a year versus 200 transactions a year. In terms of borrowers, we'll also go in more depth on this on the next slide, but obviously, we want them to be creditworthy, have a high FICO score. And one important thing to note here is we're also trying to primarily work with investors who are experienced. So these aren't people who are flipping as a hobby. These are people who are doing a number of projects a year, and they have like an actual process around it. So that's kind of what the experience level we're looking for. In terms of liquidity, we've actually found that this is a really big predictor in default rate. So even above and beyond the down payment that they put, we want to make sure that they have a lot of liquidity. And the reason being, for those of you who aren't familiar with fix and flip loans, the way they work is there's an acquisition basically loan, and then when you're doing renovations, you actually take that renovation funds out in draws. So we don't give the borrower all the renovation funds up front. They basically get the contractor to do the work, and then we make sure that the work was actually done, and then that draw is taken out. And so the reason that we want liquidity is so that they have the ability to basically float that renovation cost before we get the chance to actually do the inspection and then verify that the work has been done and give them the draw. The other benefit of high liquidity is obviously if something goes wrong in the project or some unexpected expenses come up, you want to make sure that the borrower has the ability to cover that cost as well. So that liquidity part is super important. And then finally, this covenant, I kind of mentioned it, but yeah, we don't allow second liens behind our loans, so that kind of helps out with the safety as well.
Yeah, and I'll comment there too. I imagine some people that are watching this might be slightly confused by that because we say, hey, we're holding mezzanine debt in these portfolios at second lien. And we'll talk more about the difference, in that and why these loans are originated as first lien mortgages and that there's no additional debt. But then after the loans originated, that's where it's split up and that's where we take our mezzanine portion. Sorry to interrupt, but carry on.
No problem. And then, yeah, as I mentioned earlier, we're primarily focusing on 1 to 4 unit residential properties. These aren't like commercial scale properties. And yeah, the one thing we want to make sure is that after the repair, we obviously want these to be conventionally financeable because obviously that guarantees our exit. This repair budget is kind of interesting. It may not be very intuitive at first, but basically the reason we have this cap on the repair budget size is actually it's kind of a good proxy for how complicated the renovation is. So you can imagine if you're doing a new construction, the renovation cost is going to be very high because basically the only acquisition you're doing is the land. So maybe the renovation cost might be 80-90% of the purchase price. Versus if you're doing a very minor flip, like a cosmetic, just adding new paint, like maybe doing some minor like repairing the countertops, you might have a very small repair budget. So basically what we're saying here is we want to take on projects and expose the fund to those projects, but not have them be super complicated because obviously the more complicated it is, the more chances there are for things to go wrong. So that's why that threshold is in there, and everything else is pretty standard for the industry. So yeah, we can go to the next slide. Then just a little bit about the specific borrowers that we work with. So again, I don't think I need to go through every single bullet point here, but yeah, obviously we want them to have good character. So high credit score. Do we know these people? Are they good to work with? And experience, obviously, we want experienced operators. We don't want people who are doing this as a hobby. Liquidity, I already mentioned why that's important. Collateral, also, we want to have make sure that loan to value is low. We want to be in markets where we don't see any declining home prices. And then compliance, obviously, we want to be ethical and follow the legal requirements. So, yep, next slide. Okay, so now we're getting to the main part of the strategy, and this is basically how we're able to generate such a high return. So let's just take this example. So let's say Vontive originates a 100K loan to a flipper at 12% interest. So what we can do is we don't necessarily need to buy the entire loan. We can actually buy a small slice of it. And so in this case, what the fund does, what Bozeman does, is we actually buy this B piece down here, and let's just say that we buy like a 10K slice in this loan, meaning we have 90K left over. So what we do is we have agreements with these other big institutions. I can't disclose exactly who these institutions are, but for example, we have one multi-billion-dollar credit fund that has an agreement with Vontive to buy a certain volume of these A pieces. And so if you think about it, if we make this A piece more senior, meaning as we mentioned the capital stack earlier, if for any reason there's a foreclosure or anything like that, this A piece will get paid back first. So this is one single first lien position, but we're actually cutting up that first lien position. And so in effect, we're kind of acting as a mezzanine piece when in reality, to the borrower, it's only just one loan. So because that A piece is a little bit more safe to purchase for the institution, they're actually willing to take a slightly lower interest rate. So maybe the entire mortgage is at 12% interest, but when the institution buys this A piece, they're willing to buy that for 10% interest because it's safer. So you can look through the math on the slide, and basically we're able to profit on that spread between the 12% that we're collecting on that and the 10% that we're paying out. Plus, we're collecting the full 12% on the B piece that we retain in the fund. And so, yeah, if you end up adding up all the interest that we generate through the spread and also from the B piece itself, we're actually generating around 3K a year. And our upfront investment as a fund is only 10K. So our annualized ROI on this specific example is around 30%. So this is kind of the strategy. This is how we're able to generate such a high return. We're kind of taking a slice of the overall loan. We're not buying the entire loan, if that makes sense.
Yeah, and I'll make some comments here too. One, if you didn't understand this through the first time, that's okay. You know, I would suggest rewinding. You know, when we send out the recording, going back, listening to it again. There's a couple things that are very unique about this strategy, and it works because of the fund's unique position and really in Charles' relationship to Vontiv, in that this strategy involves having a very high number of loans originated, you know, so that you can create this leverage point. And through Vontiv, we're able to do that with not just any loans, but with very high quality loans. So just some important things to consider there.
Yep. Yeah, and then so here's some more information on how exactly that works. So Um, yeah, so as I mentioned, Charles's company, Vontiv, we're getting all the loans through them. So they're the ones who are actually doing the origination, the underwriting, like actually doing and also doing the funding. And so this is very specifically set up. The reason the fund is not involved in any of the origination or loan funding of that is because that would open the fund up to some tax implications. As a fund, we want to be completely passive. And so for that reason, the fund is not involved in any origination. We're just buying loans from Vontiv. And so as for their track record, Vontiv has been in operation for around 8 years now. They've been well above $1.5 billion in loan volume in total. And so then they're still growing. So we don't really have a bottleneck on deal flow from loans right now. Like whatever funds we raise at this point, we have loans to line that up with. So that's kind of what Vontiv's role is here. And then once Vontiv originates these loans, they're able to split up the A piece and the B piece. And then as a fund, we're able to come in, cherry pick the highest credit quality loans, and then buy that B piece participation. And then once that's done, the A piece is sold to those institutions that I mentioned earlier. And like I said, they're willing to take a slightly lower interest rate in exchange for the added safety. And then as a fund, we collect the spread on that interest plus the full interest on the B piece. Here's some examples of some projects. So I think the main metrics to look at here. So the loan to cost is 80%. This is what we like to see. We want to get that as close to 80% as possible. This one was a particularly good flip for the borrower. So they managed to buy this at a pretty steep discount to market. So that's why the loan to value is so low at 54%. And then, yeah, they didn't take too long to do this flip, 105 days from start to finish. And they made a healthy profit as well through 37%. So that's how they're able to justify paying out 13-14% for a flipping loan when single family owner occupied loans right now actually just dropped to around like 6.7%. So there's one example. We can go to the next slide. So this is another slide. There's another example. This one is pretty interesting. So this is a strategy that's in Seattle. That's actually not super widespread across the country yet. So this is an accessory dwelling unit construction. And so what that means is basically if you have a single family house in Seattle with a specific size lot, you can actually build it's like kind of like a backyard cottage. And you can actually in Seattle turn that into a condo and actually sell that backyard cottage separately from the main house. So it's like a pretty crazy strategy. You can make like 200-300K plus on just one of these. And so that's why the loan to value on this one is so low. It's because in addition to acquiring, they already had the main house. So this loan was just to construct that ADU. And so since it's a more of an heavily involved project, it's not just a light flip. That's why the loan to cost on this one is a bit lower because we made the borrower put more down so they have more skin in the game. And commensurately, that's why the loan to value is so low. So yeah, I think we can go to the next slide. And then yeah, TJ, do you want me to go over this? I forgot.
Either you or I mean, basically the gist of it is that this fund is predominantly lending to single family homes. So that's the underlying asset that we're making loans to. And it's important to note that when you think about real estate as an asset class, there's a number of different assets within that. You know, there's office, there's multifamily, there's single family, there's self-storage, and they all follow different trend lines in terms of values. So over the last 2 years, it's no secret that office has seen a pretty big decline. Multifamily has seen a a pretty big decline in certain markets. Commercial has tended to decline a bit more, but single family homes have remained stable in value or have gone up in certain markets. And that's really good for this fund, because if values go up, it means that the borrowers are able to sell their properties at a profit. They're able to pay their loan interest, and it keeps delinquencies quite low. So, investing in this fund is almost in a way kind of betting that the single family housing market is going to remain stable or go up. And even if it doesn't, we still have a pretty healthy margin of safety, which Kunal discussed.
Yeah, and I can also add on to this a bit. So I think another thing that kind of makes us unique is Charles and I are very macro focused. We follow the market very closely. And so yeah, I think one of there are a few reasons why we like single family. One is Vontive in general, their bread and butter is 1 to 10 unit properties as a whole. And so even within that, we've kind of niched down to mostly 1 to 4 unit properties. And the reason that is because generally commercial real estate is much more interest rate sensitive. So we've seen, like TJ mentioned, offices have dropped for a number of reasons, but even just multifamily, I think the Freddie Mac has like an apartment value index. And I think over the past like year and a half or so, apartment values have actually dropped down like 15% versus single family. Depending on which metric you look at, there are a number of ways you can look. But I think the most recent Case-Shiller index showed that I think in the top 10 metros in the US, home prices are up like 6% versus, again, multifamily is down. So there are a lot of reasons why single family is more stable right now. I think this isn't really an economics presentation, so I won't go into too much in depth. But yeah, we do like single family for that reason. It's much more stable. The one thing Charles and I are tracking very closely is obviously interest rates. We're seeing where that's going. We're also looking at single family inventory. So nationwide, because of higher interest rates, inventory has been rising steadily over the year. And obviously, at a certain point, you don't want too much inventory because that's going to start putting downward pressure on prices. But what we're going to see most likely with interest rates going down is we're going to see a reversal of that. And again, I won't get into too much detail, but I just wanted to point out that yeah, we are tracking the market very closely, and this is something that we pay a lot of attention to.
So this slide here is just a comparison between investing in a debt fund versus investing in a syndication, and what is meant here is like a multifamily syndication. And I wanted to point this out because I think a lot of LPs get into the business of passive investing first through multifamily, and there are some differences. I'm not going to read through all the details here, but just from a high level, the liquidity is a little bit different. There's more liquidity with a debt fund, meaning that you can withdraw your capital a little bit sooner than if you did a multifamily deal, which usually has 5, 6, 7 year lockup period. As Kunal has discussed, we're providing debt capital to borrowers. And in a syndication, that would be where they were raising the equity to actually buy the property. So it's a little bit symbiotic in that way, and we're kind of moving over to the side of the debt provider. This fund's diversified across hundreds of loans, whereas a syndication, depending, it might be a fund, it might be one property. And then there are some other details on here about debt specific, things. So feel free to review on your own time. And then here is so three here, but then 2 on the next slide. So kind of 5 of the big risk factors as I see them, and then how the fund is mitigating those things. So the first is borrower risk. And we discuss this a lot, ways that the risk is mitigated from the borrowers and from the assets that they're borrowing on. We talked about margin of safety. So the loan to cost, the loan to value. We talked about the experience of Vontive, who is originating these loans and underwriting them, which is a very important part in making sure that the borrowers can repay the loans and that the assets are worth what we believe they're worth. And then also that this fund has the advantage of being able to select and cherry pick the best loans from what's originated by Vontive. In terms of manager risk, so Charles McKinney is in a very unique spot. So not only is he the CEO of Vontive, but he is Kunal's partner and GP of the Bozeman Fund. And he's been in the lending business for a really long time. And he's also heavily invested in this fund, which we'll talk about. So, he has a lot of incentive to make sure that things go well. And I think also uniquely is that this fund's been in operation for 2.5 years. So a lot of times when people invest into a syndication or a fund, there isn't a direct track record into what they're investing into. You know, they're kind of you're starting from scratch. But this fund's been around for 2.5 years. It's hit projections. It has a track record, and something that people you're investing into the loans that already exist, which I think is a nice feature. And then again, we talked about macro risk, so that's the risk of the underlying assets, which are single family homes in this case. In terms of the fund structure and arbitrage, so the returns, which we'll talk about in the next few slides, are heavily weighted towards LPs for the first, the first points, all the way really up to like the mid-teens, and the GPs make most of their money towards the end of that once the LPs have received most of their return. In addition, we'll talk about the credit enhancement fund that Bozeman Capital has set up, which is really, again, I keep using the word unique, but I don't see that a lot with offerings. And what that is half of their profits that's set aside to replenish investor capital if we do experience a loss. And then in terms of liquidity, so again, these loans are right around 11 months on average, meaning that the loans are getting paid off continuously. We're not over allocated to any one of these loans. There's hundreds of loans in the portfolio. There's no additional leverage used on the fund. The high returns come from the arbitrage strategy that Kunal discussed. And in terms of the single family housing market, if we do have to foreclose on assets and resell them, it's pretty liquid compared to some other real estate investments or commercial real estate. And this slide is really important because I don't see this a lot either in syndications. So my fund is a limited partner of Kunal's fund, and you see that a lot, but people don't disclose, kind of the involvement and what's going on. I try to be very upfront with my involvement and how I'm working with the GPs. So, like I said, my fund's a limited partner of Kunal's fund. Everything is passed through. Kunal's fund, the minimum is 250,000 because they cater more to institutional investors. And the idea of my fund is to not only do due diligence on the offering, to invest my own capital and give me a conduit to do that, but to give access to people that want to write a smaller check. And I try to do so in a way where my LPs receive most of the return, most of the return in general, and then upfront, and then I can make money above a certain threshold. And we'll talk more about that when we get to my slide on the waterfall. So now I'll toss it over to you, Kunal, to talk about your waterfall structure. So these are the terms that flow from the fund into my fund, and by proxy to my LPs.
Sure. Yeah. So we're generally targeting. So at the end result, what we're trying to do is target a 19% annualized return for our LPs. So to kind of get there, we're targeting around like a 27 to 30% gross yield at the fund level. So the way it works is we charge a 1.5% management fee, and then after that we have an 8% preferred return for our investors, which means that we don't share in any of the profit until the LPs are making at least 8%. And then above that, we actually have an 80-20 LP-GP split. So that means that up until our LPs are making 18%, they get 80% of all the profit. So we're basically not really making any money until our LPs are making at least 18%. And then above that, we kind of flip that split. So now above 18%, then we flip to 20-80 for the LPs and GPs. So the kind of reason for doing this is we just want to do right by our LPs. So we're trying to make sure they hit that roughly 19% threshold. And then any excess returns that we can generate, that's where we kind of participate in our profit. So like TJ mentioned, I think a super important additional risk mitigant that we have is this credit enhancement fund. So what we do is we actually set aside around 50%, or not around, sorry, exactly half of all the profits that we generate at the GP level. And we set aside those funds into a separate account, and we just hold that in cash. And so the purpose of that cash account is to basically, like, if there's any event where if you have to foreclose and maybe that might eat into some of the loan principal, then this credit enhancement fund will actually come in and basically absorb any losses that would have been realized by our LPs. And so we allow this credit enhancement fund to grow to around up to 20% of the total fund size. So you can imagine that as we continue generating returns, we keep adding to this fund size. We can have up to 20% of additional buffer for LPs to mitigate against any loss as well.
And then of those, of that 18% that flows into my fund, so my fund doesn't have any upfront fees. So there's no capital placement fee or asset management fee. The first 12 to 16% goes right to the LP. And that depends upon how much you want to invest. If you're investing on the low side, 25,000 is 12%. It scales all the way up to if you invest over 150,000, it's 16%. And then above that 16% is the revenue stream for my business. And what I'm doing is for the first $1 million that comes into the fund, we're actually offering an incentive. So the amount you have to invest to hit that highest return drops down to 100,000. The amount you have to invest to hit the second highest return drops down to 50,000. This is just a way to grow the fund quickly, so that the overall expenses of the fund become relatively small compared to the fund size. Otherwise, if I had a small fund, I probably wouldn't make any money at all because I'd have to pay all the fund expenses with the difference there. So if you are interested, definitely talk to me earlier rather than sooner. I expect we'll probably hit that $1 million mark in the first month or two. And then co-invest, which is something I think is really important. So this is the amount that the GPs are investing alongside their LPs. For myself, I'm investing 150,000 into this offering. I've already been in it for about a year, and I'm adding to that position. And then the Bozeman GPs have about $4 million invested. I believe that this strategy was actually born to manage Charles's money, and to produce returns for him. He's a significant LP here. That's most funds, they don't have such a high co-invest. So he's clearly incentivized to generate high returns. And then on the right, it's a slide that kind of outlines of those first few points, how much is going to the LP, especially if our gross return drops. So the fund's been performing at the target 30%. But as that amount drops to 25%, 20%, 15%, you can see on the right how much of that return is going to you as the LP. And you can see that most of it is still going to the LP. Kind of reiterating Kunal's point that we're incentivized to keep returns high because that's where our revenue streams are. That's it for the presentation. Thank you all for joining. Would love to do a Q&A session now. So if you have any questions, feel free to drop them in the chat, and yeah, we'll cover those. And if we don't, we can maybe cover a couple questions that I've gotten over the last few days. Brendan, maybe you can either drop those in the chat or you can read them out loud just off of the FAQ that we put together based on those. So one question is in regards to retirement funds, like a self-directed IRA. Yes, you can invest using an SDIRA. That's probably one of the better ways to invest in something like this because the interest income from a fund like this is taxed at the ordinary rate. So if you're a high earning W-2 professional, you're probably paying a lot in taxes. This fund wouldn't help you with that, right? So that's kind of one of the negatives. But if you invest through an SDIRA, that's a tax deferred type vehicle. You can avoid that tax bill. And there's also no UBIT on this investment, which is something that potentially adds taxes to SDIRA investments when you invest in something like a syndication or multifamily deal. So we don't expect there to be UBIT here. Talk to your tax professional about that to 100% confirm. And if you need a contact for SDIRAs, let me know. I have somebody. Want to drop another question, Brendan? So when are profits distributed? So everything's done monthly. So with this fund, they've been in operation for 2.5 years. The checks to me have been like clockwork. That usually happens about 5 weeks after the month closes. So for the first month that returns will be distributed, that would be the month of September. So you place your capital by the 22nd. Your returns start to accrue on the 1st of September, and they accrue until the end of September. And then at the end, there's a 5-week period to up until when you get your distribution. So you get your first distribution the first week of November, that would be.
Yeah, and I can provide some context for why that is. So I guess since we don't have any other questions right now, so generally the way like this works is we have a third party servicer that actually collects all the mortgage payments from our borrowers, and they actually remit that to us the following month. So for example, if we're generating returns in July, our servicer will actually send that over to us like maybe around August 20th. So we have a couple days where we aggregate all the data, run all our numbers, and then we send out all those returns from July at the end of August. So it's 1 month in arrears essentially.
Next question. It looks like one of the key advantages to the fund is Charles' relationship between the firms. What if that changes any time? How does that impact the fund and returns?
Yeah, so I mean, I would say that's like our biggest edge. But I mean, if we end up borrowing or sorry, buying loans from other companies, it's not like we don't know what we're doing. Like Charles is still able to like he still has the credit background to analyze these mortgages. It's kind of just like the cherry on top of all the credit analysis that we're already doing is that we also know these borrowers, but just because that might change, that doesn't necessarily mean like there's gonna be a massive drop in performance. I would just say that's like a maybe like that'll credit analysis will take us like 95% of the way there, and that extra 5% might be his personal knowledge of the borrowers. But I don't think that would impact really fun operations that much.
Yeah, and I think part of the essence of the question too is like what happens if something happens to Charles, so you've been his partner for a couple of years now,
Mhm.
can you speak to that a little bit?
Yeah, so I'm actually going to take over loan selection as well. So as we grow, we're going to start to split that responsibility as well. So again, not just to that, I would say loan selection is probably like the least important step in this process. Actually, generally, like the most important part is the underlying underwriting of these loans. So, example from Fontiv, we know most of this underwriting is done algorithmically. So we have a system in place where these loans have to fit these criteria, and so we can say that with a high degree of certainty that if we're buying these loans from Fontiv, we have a very high degree of certainty that these are going to be very high quality loans. And then the loan selection is probably like the last, again, like maybe 5-10% where that just adds like a slight edge there. So as the fund matures, I actually like next month, I'm going to fly out back to Seattle to work with their loan officers and get up to speed on actual loan selection as well. So moving forward, that's going to be a thing that's delegated between both of us. So yeah, in the event, if anything that were to happen to Charles, like I'll be able to pick that up as well. So yeah.
And next question, can distributions automatically reinvest? Yes, is the answer to that. So, that's something that we've set up, especially for people that have SDIRAs. It says, is syndicate better than REITs? I'm sure we both have opinions on this. It really depends. I am not one of those people that says that what I do is perfect for everybody. And I think it's a tool that a lot of people aren't aware of that they should I hope that everybody gets educated on it and it has its place in your portfolio. I can't speak specifically to the benefits of REITs. I'm not really involved with REITs, but there are a couple. So there's a little bit more liquidity with a REIT. I think REITs are a little bit more sensitive to market dynamics like general sentiment around fear, greed in the marketplace. Whereas this portfolio, it's more private and it just kind of operates based upon what actually happens. And a REIT might be a lot bigger too. Like usually REITs are in the billions. This structure is a little bit more concentrated into what we're uniquely suited to do, what we feel like we have competitive advantages in. Kunal, you have any thoughts on that?
Yeah, I think a couple. I think again the main benefit of REITs versus like a private fund is REITs are publicly traded, so they have a lot more liquidity. And so generally, like there's a trade-off between when you have the same underlying asset, but one is more liquid and one is more illiquid, you tend to pay a premium for that liquidity. And so if you take a look at like a cash flow stream from a REIT versus maybe a similar asset in a private fund, the REIT should theoretically be trading at a slight discount to compensate for that higher liquidity. So that's one thing to note. And then yeah, I kind of align with most of what else you said. Like it's definitely a tool, but I think the other main difference is REITs are more sensitive to current market conditions. So like for example, if the Fed drops rates tomorrow, I wouldn't be able to sell an apartment building immediately for way more money, but maybe an apartment REIT might jump up a couple percent. So I think that those are kind of the trade-offs as well.
Are these funds targeted to accredited investors only? Do you have any options for non-accredited? So this is a 506c offering, which means that we can only raise money from accredited investors. It's what allows us to market this publicly, so to have people in this webinar that I don't know personally. Or I should say when I do non-accredited deals, so that would be a 506b offering. I can only market those to people that I have a relationship with. So if you're somebody that's watching this and you're not accredited, but you're sophisticated, or you're trying to get more sophisticated, then reach out to me and schedule a meeting. We can start that relationship. I can listen to kind of your specific goals and needs and see if I can help you. And I guess also the point is I can send you those deals when I do have them. Because if we never meet, then I cannot market 506b offerings to you, which are the ones that you would be able to invest in if you're not accredited. What markets or property types do you invest in? So Kanal, maybe you can discuss this one.
Yeah, so I kind of gave some high level criteria earlier. So the vast majority of our portfolio is concentrated in 1 to 4 unit residential properties. And so for all the reasons I mentioned earlier, it's much less interest rate sensitive. We have more experience in that asset class. In terms of markets, I would say the general criteria is it needs to be a larger market, like a primary or secondary. Again, we don't want to have tertiary, more rural markets where the volume might not be as much. So I think we have a decent number of properties up in the Pacific Northwest because that's the market where we have a lot of experience in. Also some more in California and then spread out across the country, some in Texas, some of the bigger markets. Not a lot of exposure in Austin, thankfully. So that's something we've seen where I think we actively chose to not go to markets where there's a lot of supply. So yeah, I mean, I can't tell you every city off the top of my head just because we're so diversified. But if you think if it's a large city in one of those 26 states, then we probably have at least one loan there.
Cool. Well, if there are no other questions at this time, you can still reach out to myself if you have any questions or if you want to discuss the fund. You should check out the data room as well. We have a lot of information in there. We'll put the webinar recording in there. We have the pitch deck, and FAQ as well. And if you'd like to schedule a meeting, you can do so at the link that's in this pitch deck. And if you'd like to invest, you can do so through the data room as well. There's a link to my investor portal. So that's all. Thank you all for joining, and we'll talk to you all soon.
Thanks, guys.